This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. As always, my name is Alex Perny, and today we are pleased to welcome on with us Curtis May with Practical Wealth Solutions. And we're going to be kind of going through some basis of what people need to understand when it comes to developing a financial plan. It's not just as easy as saying, I would like to have X amount of money in my bank account when you retire. There's a roadmap to get there, and it looks different for everyone. And understanding kind of how to build that, what goes into it, is really the key basis for all of this. So Curtis, I really do appreciate you being on with us today. As always, when I do this, I always like to have our guests give a little bit of background about yourself. Most people don't just pop out of college or whatever they do at a certain point and say, I would like to be a financial advisor or financial planner. So maybe give us a little bit of background about yourself, kind of how you came to be at the point that you're in, and then we'll just go from there.
That's funny because I actually have been doing this since college. So
fantastic. Well, then we have the exception to the rule then.
So I popped out. What happened was I realized the NBA was not looking for 5'11" shooting guards, and so with a mediocre handle, right? So it's like, okay, you can come off the ball and hit this J off the screen, but you're 5'11". People that can really do that, or at that time, would need to be about 6'4" to 6'6". So I wasn't that. So like, all right. That's not that. And I am barely on the team at the Division II school. I was like, this may not be my dream. So, but at the same time, I was a business major, and I was blessed because, my family had always been in business. In the supermarket. I'm from Philadelphia. Growing up, we're in the tavern business by my senior year in high school. So I never got that go to school, get your education, get a good job talk. My dad told me you work for somebody else. So when somebody showed me the opportunity to do this, I actually got my insurance license in college, Okay. And so I basically started this in 1985. So you can date myself right there. My junior year in college, 1985. And then a couple years later, I was securities licensed. So those of y'all know that I was 663, 26, mutual funds were end all be all. And then I kind of lost my religion. In 2000, after living through my second crash, right, and reading Rich Dad Poor Dad, and I was like, what he's talking about and what I'm doing are different. And then I wanted to know about. I wanted to know. I was a nerd. Like I wanted to know why things happen. Why things don't just crash. Why do they crash, right? And why is there a way to see this kind of stuff coming? And then I realized, more to your listeners, there's a lot of ways to skin a cat outside of Wall Street, right? So the theme of my podcast is kind of like the wealth outside of Wall Street. Here are things that you can do. And so I try to, so that's kind of where I came from. So I'll stop there with that part of the story. But I was weird. I wanted to be in business, and I started doing this. So I did pop. I don't know if I popped out like that, but I popped out wanting to play for the Sixers, right? But
yeah, no, I can appreciate that. And especially kind of coming, I have a little bit of a similar trajectory, at least in my career, coming out in the middle of crashes and going through multiple ones. I mean, you got to go, savings alone, the first Gulf War and the dot-com bubble by that point. Yep. So, I popped out right at the end of the Great Recession, then got to go through COVID. It's always fun to kind of see the context and, at least history tends to repeat itself. So we can learn lessons from all these things that will certainly help apply, to future activities that you're doing. So, I really do like the aspect of, understanding that there's not just one avenue for people to create wealth. And that's, a core focus of what I've done in my career, what we do at Advanta, what we try to educate people on this podcast is that, you turn on CNBC, you hear, Jim Cramer, you hear they're talking about one thing. And while granted, it's a good fit for a lot of people, it should probably be a portion of a lot of people's portfolio, even if it's not your main core focus, but it's not the only thing out there. Again, it's not the only avenue to success. It's just saying, you know what, I'm going to pick the right stocks, or I'm going to be in this mutual fund that has a target date of when I'd like to retire. So, I'm glad that we're kind of, again, at least.
Oh, listen, I will go a step further. I'm going to tell y'all that nonsense does not work. Okay. And so if you want to be, so like if you study people that are, if you study rich people, They do not focus on what we call the accumulation theory. Okay. So the accumulation theory, buy and hold, dollar cost average, get out of debt, buy term investor difference. That's what 98% of the people that are taught to do, right? By the financial institutions. But what we teach people, Alex, are here are the 4 rules of the financial institution. They want your money. They want it on a regular basis. They want to keep it as long as possible. Why? So they can charge you fees. And so if you're successful and you start out with 100,000 and you're just in equities, you're getting $1 million. Well, that 1.5% points or 75 points, the more successful you are, the more, especially if it's a taxable account, the taxes are kind of baked into the tax cake, so you don't see it. But that's so anyway, if people saw that, they would kind of look at that stuff. But basically, what happens is it's just hard to get enough money to do that. Whereas if you can buy assets alternatively with the emphasis on cash flow, right? So a mixture of growth. You want growth and you want cash flow. So if you can buy assets that send you a check, so eventually you can turn on that cash flow, now you can be, because people talk about retirement. I don't talk about retirement. We talk about financial freedom, right? And so financial freedom is a capability, right? And so are you capable? Do you have assets? What's an asset? Just a la Rich Dad, right? Something that puts money in your pocket. And are you capable of having passive income greater than expenses at some point in your life, right? And that's the goal. So you got to begin with the end in mind. And then you got to ask yourself, well, what things can I deploy my capital that will let me do that? And so we kind of back into it.
Sure. So let's kind of start at the beginning. You sound kind of like, like in your own words, is that you kind of started in that initial mindset of the accumulative, wealth model of saying, okay, I did my insurance, and then I got my, 6, 67, 7, FINRA licenses, and I'm doing stocks, bonds, mutual funds. What would you say is kind of the awakening that you had to say, okay, I've seen this happen? Was it just kind of going through the crashes? It sounded kind of like around the .com bubble is when you kind of
around the .com bubble. So I was around that time. I was working with a Citigroup subsidiary, and I was doing the teachers what do you call 403Bs in the school district, right?
Sure.
And so the challenge, I inherited this. This is what really, this is why I had my this is where I lost my religion, if that's it, so to speak. And so I had I inherited this client. She was 68, right? From this guy that was asleep at the wheel, just kind of throwing people in funds, right? And so I looked at her stuff. She was 68. He had her in so I won't name the name company, but this technology fund. He was obviously chasing returns like most people do. She didn't know what she was in. She was just picking, all right, this one did 50% last year and yada, yada. So she was all these, what I call unsuitable things for her. And then the market went down. So she proceeded to lose after 9/11, her funds dropped 50 grand in 3 weeks.
Oh yeah.
And then I go to the wholesaler from this company, if I know you would name it, coming down from Mount Olympus to grace us with his presence. Right. And I go, I told him the whole story, 68, da, da, da. He says, don't worry, the market's going to come back. I was like, what did you say to me? Did I tell you she was 68? Don't tell me this BS. I didn't say BS.
Yeah.
I didn't say it, actually. I was thinking it, but I was incensed. How dare you tell me this BS? And then I had read Rich Dad Poor Dad, and then I had discovered this book called Become Your Own Banker by then. I didn't understand it, but then I read Creature from the Jekyll Island, and I'm starting to understand economics in one lesson. So I'm starting to understand business cycles and why things happen.
Sure.
That was the genesis of that. And so that's when that fed my nerdy part of my brain, because I'm a closet nerd. I'm not even closet anymore. Now I'm proud of it. I was a jock.
Come out of the closet, march in the street with us. Nerds unite, right?
I told my daughters I was a cool nerd because I was also all city in basketball, but I had this nerdy streak because to me it wasn't cool being a dumb jock. It was not a cool thing. And so it's that. So I kind of grew to that, and then I was like, why don't I know what's going on in this? And then I started to. This is probably later, but there was I heard the term uncorrelated assets, right? And then one of Rich Dad's book, Rich Dad's Guide to Investing, he says that there's 4 asset classes. This is the third book, right? There's 4 asset classes. I think he talks about 3 in his next book. He talked about the 4th one, but it's business, real estate, paper, and commodities, right? And so people just think of one thing, paper. EFTs, like you talked about before, mutual funds, CDs, REITs, all those things are Wall Street packaged stuff where most of the profits go to Wall Street, right? And so what happens is investing is more about becoming something than buying something. And so what's great about, so if you're using what your company are using IRAs, what you want to do is, where's your capital at, right? So, but you don't have to just do prepackaged stuff. You need to research stuff. Like we have clients that do notes, right? Where you can literally buy the note from the mortgage, right? You can get into note, you can get into syndications, right? You can get into where you can get into apartment buildings, you get into what are those things called? What's the thing where you are storage unit, self-storage, and so most of those things you need capital. You need 50, 100,000, and so you can leave it sit at risk in equities, or you can research the operators, see, because here's our 3 rules of investing, Alex. It's invest in what you know, or invest in knowing. Okay, knowing what? Knowing the operator, knowing don't just treat it like a mutual fund. Oh, I heard this alternative investment. All right, I'm gonna do my letter of intent and let's send this money over. You need to know how things work, right? And then so you have to learn how to do diligence. That's what I mean by investing and knowing. So you hold the capital, allow them to put these funds to work, but you still have to drive the car, right? You as the investor, you still have to. And I'm gonna argue. I'm gonna come back to this. Investing is last. It is not first thing in terms of building a stable finances. That's why I told people, look, Curtis is a defensive coordinator, right? So by the time you get to Alex, that's offense. That's your job, right? To understand this stuff. But you can. So we say business, real estate, paper assets, and the 4th asset class is commodities: gold, silver, right? Oil and gas.
Sure.
There's I've seen this thing on this guy's show. I'm trying to find these guys, get them on my show, where you can buy like coffee farms in Panama, like an acre and a half for about 20 grand. You can do those in an IRA. Right?
I might know the guy. I think I might have even had him on my podcast. Is it the Green Coffee Company?
Yes.
Yeah. No, I can connect you with him. I actually interviewed him on this podcast. Yeah.
Yeah, I like that stuff, right? And it's willable, and they'll average 10, 12% a year, and they cash flow. That's what you want. Like it's willable. And but so what happens is you just have to expand your vision as to what's out there. That's why you listen to shows like this, because you don't know if you don't know. And so you got money, and success is when opportunity meets with preparation. So if you prepare yourself and then you see the opportunity, now you've got, all right, here's some capital I can do private lending. A lot of times there's dentists that have a lot of money in qualified plans, and they'll loan money to people that are real estate developers, and they'll make 10, 12%. So you just have to be creative, but you need to have a foundation. So I love that stuff. You just have to be willing to. I was watching Alex, what's that movie? The Replacements with Keanu Reeves.
Oh, great movie.
I love that. I've seen it every time it's on. I finish it wherever it is. I end up watching the whole thing. But he says, winners want the ball, right?
Oh, absolutely.
And so you've got to want the ball, right? You've got to want to more control over your money. And
absolutely.
So yeah, that's why I teach.
Kind of my question is that we can individuals like us, we can sit here and kind of pontificate like these great principles, but they in practice is kind of where where the rubber meets the road, is trying to figure out how this applies to someone individually. And I'm assuming kind of from the perspective of what you're talking about, and it was good that you gave the example of the client you inherited with the 403b that was in the wrong things at the worst wrong time. But the conversation you have with a 63-year-old about to retire school teacher about if they're because not everyone starts out perfect. It's and there's no such thing as perfection. It's a spectrum of everything. So the conversation you have with someone like that versus someone, let's say like a 35-year-old man like myself that's saying, hey, you know what, like I want to like get in a better position. I have certainly much more time, knock on wood, to do stuff. But I think it's definitely beneficial for people to hear kind of, your take on what kind of conversation you have with someone. And let's kind of assume the avatars are the same, that, I plug money, either I just have done no investing and it's cash, or I'm in the ETF, stocks, bonds, mutual funds, and I want to then in turn move. Is it kind of a position where you're saying, what do you have the conversation is like, hey, what are you passionate about? What would you like to accomplish? Because not everyone can be a stock market expert. Not everyone cares about real estate. So what is kind of the path forward of trying to figure out, what is the path forward for someone, again, call it 35 to 68 that want to get in a better position?
So it's the same, right? So we teach principles, right? So principles are, if you read Ray Dalio's book, every successful person operates with principles, because if you didn't, every time a situation came at you, you wouldn't know how to handle it, right? So we teach financial principles, which there are 5, and and if you want to hear this in a different language, then I suggest you guys read the, I'm actually working on a mini course on this. Maybe time this show comes, I'll have done it, Alice, and I'll send it to you. But it's called The Richest Man in Babylon. So I'm working on like a mini course where I just teach it for free and teach people how to use it. But the second chapter is called The 7 Cures for a Lean Purse, right? So before you get into all this stuff, here are the first 2 pre-principles, even pre to my 5, which we'll go over in a second. 1, part of all you earn is yours to keep. Right? That's a principle. So you have to pay yourself first. And so when I say that, I don't mean fund your 401k. Okay. Savings. Let me define it. Safe, liquid, accessible, guaranteed. Okay. So savings accounts, money market accounts, CDs, permanent life insurance. That's where you store cash. Okay. And so and then you got to spend less than you make, which means you have to manage cash flow. Most wealth is lost in how people manage or don't manage cash flow. So where the rubber meets the road is when you earn money and it hits your personal economy. Are you managing it, right? Or do you have a lifestyle ceiling? Are you spending? We teach people to save 15-20% of their gross income, and a lot of people are spending 110%, right? Because they haven't managed their debt. So you have to manage what we call Parkinson's law, which says expenses rise to meet income. So if you don't do that, nothing else matters. If you can't spend less than you make and pay yourself first, so you have to start with that. So you have to get out. So look, your sheet of paper out. So look, here's what's coming in, here's what's coming out. Or I don't really like budgeting, but almost for lack of a better word, budgeting. We teach something called cash flow mapping, whereas we want to teach people to forecast, to tell your money where to go instead of asking where it went. So that's the first thing I do with people. What's coming in? Where's it going? And are you paying yourself first? Okay. So now, once we teach that, then the everything else is like, and this is where I find people want to jump right to investing because investing is sexy, right? But the first thing you have to do is save. Right. And so you've got to spend less you make, so you save. So I kind of talked about the process of how we do that. The second step, or we call principle 2, is protect. You have to protect the kingdom. You have to, what is that? That's insurances, right? So you got to protect your stuff, right? So that's proper liability coverage on your auto and proper replacement costs on your homeowners, and at least $1 million of umbrella coverage. So you get with your whoever does your car and auto. And I had a client I sent him back to this person. Said, listen, you need umbrella coverage, and he said, well, oh yeah, I got it. How much was it? $400 a year.
Mm-hmm.
Right? It don't cost that much, right? And so, but now what happens is because what's the purpose of insurance? To indemnify you, right? Because so if you just had your money invested, you had a loss, you had a fire, you had to live somewhere for 3 months till your house got built again, you didn't have insurance, you'd have to liquidate all your investments and start all over again, right? So you got to transfer risks. Health insurance, obviously, you got to protect your income. So if you don't have disability insurances, then you could not work. And then the same thing, all your investments, you got to liquidate your assets. You've got to do whatever because you don't have any money. You might be able to get a little bit of debt, but then that's going to stop because you don't have the ability to pay it back. So you have to play defense. What if you die? Most people are underinsured with life insurance. You know, if you're 40, well, let's say 35, you can have your annual income times 25. Okay. And so I believe I only like term and whole life. That's another thing I want to go into. But there's nothing wrong with term. If your goal is get the most insurance for the least amount of money, you buy term. But there's a myth out there of self-insurance, which is my third principle, that, we can have enough money, don't need insurance no more. That is complete nonsense. Okay. And so I want to say it this way, because there's a myth out there. When you have enough money, you can let your insurance go. No, you can't. Okay. So this is kind of a trigger for me, Alex. I'm gonna hit it and quit it. All right. And so what happens is if you had homeowners insurance, no, I'm sorry, Alex, let's say you had a house, right? And you paid your house off. Would you drop your homeowners insurance?
No, and I know someone that did that, and a hurricane came through and put a tree through his roof.
Boom, right? And see, so what happens is, here's a second scenario. Let's say you had a house, you paid your house off, but you had set aside $500,000 for the house fund, right, to cover the assets. Yeah. Would you drop your homeowners insurance then?
Probably not.
No, probably not, right? Because again, you for $1,000 a year, $1,500 a year, whatever, you transfer the risk to the insurance company, which frees up your capital to do other stuff with it.
Yeah.
Right. And so it's the same thing with life insurance. It's asset insurance, right? And so it makes sure that should you pass away, you've got a tax-free fill up of the money bucket. Okay. Mm-hmm. And so that's critical. So, right. See, most people skip that step because it's not sexy. They want to get right to the quote unquote good stuff. Right. The third, which is principle 5. Principle 3 is full replacement of assets at death. Guaranteed. Okay. So guaranteed. So that's what we call the myth of the theory of decreasing responsibility, the myth of self-insurance. That's why in our firm, we don't use, which is the most popular type of insurance right now in the life insurance industry, index universal life, because there ain't nothing in it guaranteed. Now, I'm going to step on some toes there, but Curtis is in a toe stepping business. I don't care. And the fourth principle, and this is where people drop the ball also, is liquidity. They're way too illiquid, right? And so we teach 90 days. So this is where it comes back to principle 1. If you don't pay yourself first, you can't accomplish this. So I want your emergency fund in safe, liquid, accessible, guaranteed accounts, 90 days. Okay. Then everything from 4 to 12 is your opportunity fund in things that you maybe buy outside your qualified plans. But if you still have money in qualified plans, that money now gets put into principle 5, which is velocity. So velocity of money are where you're taking your capital and you're looking for assets that you understand that you can buy or build that generate cash flow. Mm-hmm. And that's the 5th principle. So this is the foundation that we try to help people understand, because I find that even when I'm talking to really successful real estate investors or business owners, their foundation is shaky because nobody's taught them how to kind of organize themselves and have a holistic view of their personal economy. Most people that are in small business, the advisor just wants to sell them mutual funds. They want their goal is to send their money away from their business, right? Mm-hmm. Whereas I want you to keep enough money because your number one investment is the business. Okay. And then you put your profits somewhere else, but you need to be liquid for opportunities that come up, for COVIDs that happen, for whatever. And, there's precedent set, right? And so you can't have too much liquidity. So I'm big on protection, managing cash flow, transferring risk through insurances, and then making sure that you have lots and lots of liquidity. Because if you have money, opportunities will find you. If you have money that you've put into a position through the qualified accounts you talk about, then you could do private lending. You're tired of the Wall Street roller coaster where somebody bombing something on the other side of the world affects your portfolio. So if you're tired of that, that's when you start to look at other stuff. I'm not saying not do it. I'm just saying, I had a client just before we got on the call. She texted me, what do you think? Should I do index funds or da da da? And I don't answer questions directly like that. So listen, on the scale, now she's a really successful real estate investor, financially independent already. I said, I'm going to say, listen, on a scale of 1 to 10, we know about the stock market. Right? I said, because I'll ask them on a scale of 1 to 10, you know about real estate. She'll say like 2. I said, well, what do you know about real estate? Oh, she's like a 12.
Yeah.
Where do you think you should be?
Exactly. Yeah, and I kind of preach that as well. Is that certainly it's in my financial best interest to get people to use our service, but it's also a very practical question. It's how much do you understand about the stock market? I mean, it is. I have over a decade of experience in finance. It still is insanely complicated. And sometimes it's complicated by design. I think that some people might say it's a little conspiratorial, but sometimes it keeps people from asking a ton of questions. It doesn't need to be that complicated, but it certainly is. But not to digress too much on my personal misgivings about the U.S. securities market. I could be here for hours on that one.
Yes.
But let's so we've illustrated kind of your core steps. There's 5 of them, right? So you have your first step of cash flow mapping, protection of assets, replacement of assets, liquidity, and velocity of cash flow. Now, it's kind of easy for someone, again, it's the academic part of just, reading through and kind of understanding something that someone is trying to educate you on. That's easy. The practical application is where, anyone's going to stumble. You could, have a test on someone that could score 100 on just, Scantron knowing what you're talking about. But in practice, again, is where these things kind of tend to start to show their cracks and fall apart. So what would you say is kind of the most difficult part of this for people to maybe not necessarily do? Because just starting something is probably the easy part, is maintain a level of control and continuity in doing this. Where do you see people kind of fall off? So that way, if people are, listening to this and looking introspectively, knowing what they might need to revisit or make sure they stay on top of.
I think the first thing is to create a system. So for example, when I say save 15% or pay yourself first, that is not a willpower thing. That needs to be automated. So for example, if you don't remember anything else I talk about today, we call it setting up a wealth capture account. So a separate account. So if you're still working or if you're in business, if somebody makes $100,000 a year, just for round numbers, I would want them to save 15% of their income at least, or $15,000, right? And then if they were working, we would say, all right, let's do that, divide that by 26. You get paid 26 times. So that's like I think it's like $576 a pay, right? So can you do that? I'll ask people. And then can we set that up so that every check, this gets direct deposited into a separate account, right? Mm-hmm. So you don't worry about it. And so now you're saving 15% off the top, automatic, and then you have to live on 85%. So we don't try to make it thing. You're boom. Because if you look, you can save 20% of your income. I don't care what you do the rest of it. Right? Mm-hmm. Because everything else, the liquidity will take care of itself, and you've automated that. So now, if you're learning, but now if you're reading 10, 15 pages a day on money, like we're challenging our people, I'm sending out an email list. Here are the 12 books you should read. Or I'll say, what are the 12 books you're going to read this year so you can grow your knowledge about money, business, investing, because you have to increase your capability. It's where money comes from. Money comes from skills. Right. And so money's a result of creating value in the marketplace, your income. Right. And so that's like the first step. The rest of it, we kind of help people do, because the main thing I teach is most people, it's like there's only 2 ways somebody in the financial business can serve you. One is to help you find better investments that pay a higher rate of return. Okay. And that's what most people are looking for. But the only way to do that generally, especially in the equity market, is to take more risk. Mm-hmm. Right. I view risk as probability of loss. So, and not opportunity for gain, like you're being led to believe it is. And so the other way is to help people become more efficient with their capital. And so I kind of do the latter. I take the latter approach. So what happens is, if you will look at, so once you get control of your cash flow, then we help people look for what we call wealth transfers, right? What is a transfer? It's money that you're losing unknowingly, unnecessarily. So once you identify it, you can either eliminate it or minimize it. Then that money we freed up, you can now do what? Move into your wealth coordination account, and then you can begin to move that money into other things, right? So without going into a great detail, there's like 15, but like the first 5 is what we focus on. So when I work with somebody, what I'm looking at when I look at their numbers is like, okay, here are so one is, do they manage cash flow? Are they spending more or less than they make? That's 1. 2, how they pay their mortgage. Are they have a 15-year loan? Are they paying extra on the mortgage every month, which is a complete waste of money? I'm gonna let that sink in, guys. I know I stepped on some toes there. And so you can email me and ask me why, and I'll see you. I got a video. I got 2 videos somewhere on my YouTube channel now or on my show on why that's in this environment, right? When you got a 3% mortgage, if you like, you already have a mortgage, there's no reason with inflation, because you got to understand a defining moment, Alex, that we teach is because of inflation, money will never be worth more than it is today. Mm-hmm. Right? So why would you transfer your more valuable today dollars to the bank? Because they know that rule, right? But they entice you by lower rates. Why do you think the rate is lower, the 50-year loan? So they can create velocity, which is the opposite of accumulation. They focus on velocity of money, right? Teach you to accumulate. 2, more taxes. Taxes is your number 1 wealth transfer. So how can you minimize current and future taxation? Okay. And so I look for that. 3rd is how people are funding their qualified plans at work, right? So if you already have them, great. If you're still working, maybe you don't want to fund it past the match. I will get the match to get the free money, but if you don't have like 90 days in your emergency fund at least, then I think that I would back that down, because if you don't have money that you have access to capital to, then what do you have to do? You have to take the penalty and what I call liquidate, or you got to go into debt. And now you're spending money you've not yet earned. Okay. How people fund educational expenses and how they finance things, how they pay for big ticket items. We call it big ticket item is anything you can't pay for in full within monthly cash flow, right? And we say don't liquidate for a current lifestyle expense. We teach a strategy called the private reserve strategy. Some of y'all may have heard of it, called privatized banking. And it's a saving strategy. It's where you store your cash, and then how can you access capital through collateralization without having to liquidate to use, right? And so, but we incorporate it. It's not like the end all be all. It's not. There's no product in of itself that's going to take you to glory financially. Okay.
Except for winning lottery tickets.
Yeah, exactly. Right. And that's, and you have to play, right? I don't play. So that's and nobody's going to strike a old well in my backyard. So I need to learn the game of money. And it's everybody's looking for home runs, but it's slow and steady wins the race, right? So they feel like they're behind, and so then they go out and they try to take big swings and knock the ball out the park, but you can still get a home run with 4 singles, right? And what part of what's like, so the opposite tack I take, Alex, is one way to win is stop losing, right? So let's become more efficient and let's keep more of the money you're already making, because the number 1 asset you have right now is your ability to earn income. Well, let's maximize that asset, keep more of that, and then you begin to buy and build other assets that can go to work instead of you.
Yeah, exactly. And someone made I was interviewing an individual a while back, and he made the good analogy. He said, would you rather have the quarterback that throws a Hail Mary every play, or the running back that guarantees you to get 4 yards per carry? Because that running back will win you the game every single time.
Exactly.
So I'm a big fan of kind of, one of the core focuses that you're talking about is that it's a very practical approach to this. It's, again, understanding risk, understanding that you don't have to overcomplicate things. So, I mean, at the core of what you're really talking about is, saying, make sure that you are saving money, make sure your expenses don't exceed your income, make sure that you protect yourself for a rainy day, insurance, all that kind of stuff. And again, these are just the very high level of these things. Make
Mm-hmm.
sure you have enough money to pay for expenses and your liquidity, and then also make sure that you're making money. All this stuff is great, but if you aren't, accumulating money on what you earn, then again, all this, is kind of moot. These things all work together. They are independent, but they all, form the wheel that gets the car down the road.
Mm-hmm. Mm-hmm.
And to that point, do you kind of recommend, I think a big part about is, like you said, you ask your clients, on a scale of 1 to 10, how well do you know the stock market? How well do you know real estate? I like to be a student of the world and whatever I'm doing and try to constantly learn things, but that can also be kind of a detriment in this scenario. It's like, oh, I don't know much about the stock market. Let me learn. How do you recommend people kind of try to keep their core knowledge base intact? Do you recommend people try to learn as much as possible, because you can get kind of spread a little too thin? So how would you tell people to mitigate that? Or is that just kind of the relationship that you build with your clients on kind of understanding their penchant for, understanding maybe more than they can handle?
Yeah, I mean, it's what I try to do is I really try to reinforce that the philosophy of the principles, but the velocity method, right? So velocity, which is velocity, the economic principle of moving money in and out of assets, the focus on cash flow, the focus on leverage, using other people's money, and the focus of storing places in permanent strategy. So permanent insurance strategy. So we do what the institutions do. So I tell people, look, in the bank, don't do the banks tell you to do what they do. So I found that all of those strategies work in personal finance. So now what you invest in, again, that I don't try to play in that arena, right? Because remember what I said at the start, it's about becoming. So it's not my job to tell you what to become, right?
Mm-hmm.
So what do you have? I have clients that really are killing it with trading. That's a paper strategy.
Mm-hmm.
I don't have time to learn that. Okay. Out of the 4 asset classes, I'm my dad's son, right? So my favorite asset class, which I also think is the fastest path to cash, is business, right? So I would rather invest in my businesses because I know it. I can influence the outcome of it, and I'm not chasing returns. So it goes back to my 3 rules of investing. All go there, right? I've got people that I work with a lot of real estate investors, so I'm kind of like the financial advisor to real estate investors, business owners, and so we talk. They already get velocity and leverage, right? But they don't have necessarily the plan. They don't manage cash flow well. Business owners. I spoke a couple years ago to Laundromat Millionaire Conference, right? So velocity in their terminology is they want bigger, newer machines so they can get people in and out the mat faster, right? And then market to get people. So that's velocity, is they can turn over money faster. So see, the principles don't matter what asset class you're in. Paper, private lending. So I've got doesn't love real estate. He had a lot of money when I met him. In self-directed, we show him how to move new money into permanent insurance, and between those 3 assets, he works with real estate investors, and he's making 8, 10, 12% loaning them money.
Yeah,
so it's what you like, and then you got because what happens is it's if you like it, you're going to do it. You're going to be interested in going deeper on it, and the more you go deeper, the more, as your knowledge goes up, your risk comes down.
Absolutely. And I think that's a really good point to make too, is it's a very, kind of intrapersonal, point to make, but, do what you enjoy. If you want to get out there and exercise and you hate playing softball, but you love playing basketball, then go play basketball. It's like just because someone told you that, softball burns more calories than basketball, if you're never going to do it, you're not going to,
it doesn't matter.
It doesn't matter if you're never going to go out and do it. But if you love playing basketball, go grab your, basketball, your shorts, and hit the hoops. It's that kind of correlation. What I also, granted, I am not an advisory capacity for my clients, but when I get asked, externally from work or anyone, I was like, do what you enjoy and do what you think you can continue to do. Because if you don't think you can commit to any of this stuff, then, well, that's a whole other conversation you need to have with yourself of figuring out, why you don't want to do that. But at the end of the day, if you hate reading stock tickers, but you love going out and getting boots on the ground and meeting people with real estate and talking and fixing their real estate problems, then do that. You will 100%, even if the market's doing X, Y, and Z, I can, I have to disclaim, I can't guarantee anything. There's no such thing as a guaranteed return, but I will, with a certain degree of certainty, you will do better at that than anything else, just because you want to do it and you will put more hours into doing it.
Yeah, and so if you've got capital, then but let's say you don't really want to learn how to buy apartment buildings, but you've accumulated a lot of money. I would still learn how to read the numbers, learn how to read the financial statements, and meet the operators, yada yada, before you just put your money there. Like, because sometimes I find people will treat that money like a mutual fund, like lazy. They're lazy with it, and they won't really get in and do their due diligence, which has happened to me. And then I realized, oh, okay, you can lose money. Everybody doesn't do what they say they're going to do, right? So the investing knowing is learning how to do good due diligence. And that's all of that's part of it. Like, there's no just one thing. You got to nothing. If y'all listening, anything that you are good at right now, there's nothing where you didn't have to put in work, you didn't have to study, you had to put in the hours to have discernment to get good at it. Well, money's the same way. There's fundamentals. It's like basketball. You gotta learn how to do a pick and roll. You gotta learn how to pass the ball properly. You gotta learn how to jump stop. Or football, you gotta block and tackle. That's, in my world, that's paying yourself first. That's proper protection. That's building money for emergencies. That's building legacy. And then now, once you've got your because see, the financial plan, what you want and why, precedes the investment plan and the business plan. But see, everybody skips into that because sometimes it's not sexy they just want to get you, because a lot of people are transactional, right? And really what you want to do is you've got to look at your overall situation, and investing is a team sport. So a lot of times it's not one person, it's a team of people all working, kind of like the family office concept, which is in my mind I'm trying to develop for our clients, and like upper middle income people. But I think that you should still have a team approach where everybody's on board to make you rich, right? to make you financially free. Sure. And everybody, it's like, I'm a Star Trek fan, right? So Jean-Luc Picard pulls the team into the ready room, right? And asks for opinions, right? But the captain makes the final decision. That's you leading your wealth.
Oh yeah. And remember, always listen to data. He
always listen to data. Data's the smartest one there.
No, I think that's all really great points. And the only thing I would kind of add on to that is I'm a big, I think kind of a core focus of what you do is education and learning. Whenever anyone asks me anything about due diligence, you need to be careful about where you get it from. Understand the reason why someone might be giving you information. Are they trying to turn and sell you something afterwards? Are you getting the information from the people that are trying to sell you the investment? And not to say that you can't get good education from these people, but with anything when it comes to your personal finances and educating yourself on any type of transaction, just understand the reason why you're getting the information from a certain place. The more, high level and the least they have to do with it, maybe the better information is going to be. But just be wary. Always be a skeptic of everything, and just understand where the stuff's coming from. Not to say that anything is good, bad, or indifferent, but again, just education is great, but not all education is created equal.
See, because I think that I really work hard, Alex, is I try to teach people to think, not what to think.
Yeah.
Right. Because you have to be able to separate facts from somebody's sales pitch.
Facts from fluff.
Guys, is education, right? And so that's where it goes back to principles. So what are your money rules? So if I'm looking at a thing, what are my 3 rules? Do I know it? Do I want to know it? Can I influence the outcome? Or am I chasing return? So that's my filter, right? You got to have your filter. Exactly. And then within my principles, all right, I got to save, I got to protect, I'm a little, so sometimes, look at insurance, that's an expense. And so, but it's a protective expense that could set you aside. So you might have less to put away, but what happens if hopefully nothing happens, but what if it does? Right? You got to protect yourself. So that goes back to the principles. What happens if you don't make it? Your family's supposed to be financially free, whether you're here or not. So that's the protective, and that's legacy, right? Trust and that kind of stuff. And then there's liquidity, so that if opportunities good things or bad things happen, you can deal with them. And now you don't have, so if you're big in the stock market, the liquidity is a volatility buffer, right? So if things are down, you don't have to liquidate your shares if you like assets. A lot of alternative things are illiquid if you need money.
Yeah.
Anyway, right? So that's why it's like it builds on each other. That's where the principles build on each other. And then you're like, okay, every year is my assets, are my assets growing? Is my non-preferred debt going down? Is my business revenue going up? And is my passive income going up? And those to me are the key performance indicators that we work with our clients. And to quote the gap in the gain and 10x decision 2x, all progress is measured backwards. And so we do this thing called a personal financial snapshot with our clients, and it's set up to measure backwards, right? So here's where you are when you met me. Here's where we are December 31st, 2024. And here have you grown? Because it's really easy to track financially. I don't do equity because I don't have a working crystal ball. So I'm not, and if the thing went up, that's an illusion because, equities go up, they go down. So they don't earn compound interest. They're worth wherever they're worth at the end of the day, whatever the net asset value is at the end of the day. So it's all an illusion.
Oh yeah.
And so I like real things that throw out real money.
No, I can definitely appreciate that, and I think that's kind of a good place to bring it in for a landing. Is kind of the finality of what you're really passionate about. And I think it certainly came through in our conversation today.
Think so?
No. just a touch, right? So yeah, what I always like to do at the end of it, if people are interested in learning more or getting plugged in with you, because you certainly are a service provider, how can they find you?
So, one, you can go to practicalwealthsolutions.net or practicalwealth.net and go to our website. Actually, Alex, I'm gonna send it to you. I have a special website for your listeners where they can go. Go to my YouTube channel so you can find out more about the madness that is Curtis. Okay. You can follow me on IG, Instagram at Curtis May 4766. And we also offer a complimentary consultation. And also, if you will text, I have a report called The Value of Liquidity. And so if you guys will text Be the Bank, all caps, all one word, to 55444, we'll send you this really interesting free report, talking about having access to capital. And that's the best way. Check out the Practical Wealth Show podcast.
All right,
more like this.
Well, Curtis, I do appreciate it. The most valuable asset that we all have is our time, because we can never make any more of it. So thank you for taking about an hour out of your time to be with us today. As always, this is the Alternative Investing Advantage podcast. My name is Alex Perny, and thank you for joining.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.